Good morning and welcome to Financial Accounting. As always, we start with a look at our calendar. So everyone completed the exam on or by Sunday. I have transferred all of those grades up to and including the exam into the Blackboard gradebook. So your Blackboard grade should be up to date and reflect your current position in this class. I also raised kudos and flags yesterday related to that exam. So if you did a great job on the exam, you should see a kudos. If you missed the exam, which shouldn't be anybody here, but if you missed the exam, you should have received an email from me, from Starfish, from me about that. So please make sure that you check your emails and contact me if needed. As we look at our calendar for today, then, we finished Chapter 10 on Monday. So the Chapter 10 problem is officially due today. However, just like last week, we have a drop-in review session scheduled for tomorrow afternoon. And at this point, the topic for that will be the Chapter 10 problem. So if you have questions about that, you're stuck, you're not sure how to proceed, please try to join us tomorrow afternoon. You'll want to register for that in Starfish, and we talked already about how to do that. Go to your courses, and from there you should see by this course my name and a button that says review. And if you click on that review button, then it gives you the option of signing up for the drop-in review for this class, Business 1510. It does also show you the Business 1521, but that's not the class you're in. And they're trying to fix that so it doesn't show you both. If you're in one class, it should only show you the one that's relevant for you. So if you are able to join us tomorrow, please sign up in Starfish so that I know you're coming. If there's something other than the Chapter 10 problem you want to talk about at that session, you can send me an email or just tell me at the session. But if it's something I might need to prepare for, like getting some extra exercises together to continue working on something that's troubling you, it would be helpful to know that in advance. So that's the drop-in review session for tomorrow. It's optional. I will record it. And so if you can't make that session, but you really do need assistance with that Chapter 10 problem, you will be able to watch that, and that should be available for you later in the day or in the evening on Thursday. So if you need help with the Chapter 10 problem, do not feel like you need to submit it today because we're going to be working on it tomorrow. So take the time that you need to do that.
Are you signed up?
I can't show you completely how to do it, but I can show you on your own computer since you're here. But let me just get this out of my way and I'll kind of give you some guidance here. So actually, no, that's not going to work. One second. Okay, so there was a question about how to register for the review session. I can't show you exactly how to do it because I'm not in this class, but if you're in Starfish, and this is what you're seeing at the top, if you're in Blackboard up at the top, you should see the link for Starfish. It isn't part of the single sign-on, so you do have to sign in again, but it is your same username and password that you use to get into Blackboard, get into your JCC Gmail, and so on. So you just click on that Starfish link. It takes you to the home page, your home page for Starfish. But then over here where you see these three lines up in the top left-hand corner of the screen, if you click on that, you'll see a link in that navigation panel that says courses. And if you go to that, you will see all of your courses. You'll see links for your instructor for those courses. And if you just scroll down till you find the one that says this class, you'll see a link that says review, and you can just click on that and then click the radio button for Business 1510 drop-in review, I think is what it says, and then just continue following those steps to sign up. So hopefully that helps. I mean, I'm not able to show you exactly how it works because I'm not a student. So If you are trying to attend and you just can't figure out how to get registered, just let me know and I can help you through that. You can always attend without signing up, but it is beneficial to be signed up for a couple different reasons. So please do try to sign up if you plan to attend. So back to our calendar. So we finished chapter 10 on Monday, so that means we'll be starting chapter 11 today. So the chapter 11 pre-quiz should be submitted for grading. As always, score 60% or higher, you get full credit. Less than 60%, you get no credit. So that should be submitted for grading by the end of the day today. As you can tell, looking at our calendar, there's something going on next week because we have nothing due, and that's the first time all semester since the first week of class. So you can tell that we're on break. So today will be our final class for this class until Monday the 18th. So break starts after Friday's classes if you have Friday classes. So we'll start chapter 11 today. We will finish that up the day we get back on the 18th. And then the problem will be due on the 20th. And then exam 4 comes up on us very quickly. I know we've talked about this already, but just a reminder, it does come very quickly because it only covers 2 chapters. So my intent, my expectation certainly is that I will get all caught up with grading your annual report project pieces during that break. So anything that's outstanding should be evaluated by the end of the break, by the time we meet again. And I would hope that you would have a chance to do the same. If you have any outstanding assignments that you've been working on, you're stuck, I will be available over the break. I'm not going anywhere. I do have a few things scheduled, so I'm not available 24/7. But if you are working on something and trying to get caught up, please don't hesitate to reach out for assistance. I can help by email. If necessary, we can schedule a Zoom meeting. I don't have any appointment times in Starfish, but I would be happy to add an appointment if that will help you get caught up and be ready when we get back to just power through the rest of the semester. You can really see the rest of the semester on the screen here. So we'll cover chapter 12 and 13 and chapter 14. We finish on the 9th of May. So that will be our last regular day of class. We will finish up the last chapter on the 9th. The problem is then due on the 11th. The 11th is officially a class day, but we won't have a formal class on that day because we will have completed all of the material on the 9th. So I'll be available on the 11th. I will be here on campus, of course, and I will come down to the classroom at 9 o'clock to see if anybody is here needing assistance. If we did need to have one final kind of drop-in review, that would be the review sessions during our regular class time on the 11th. The semester officially ends on Friday the 13th. How's that for good luck? And the exam, the last exam, it's not a final exam because our definition of a final exam is one that is cumulative for everything that we've covered throughout the semester. This exam, the last exam, covers only chapters 12, 13, and 14. So just like all of the other exams earlier in the semester, it covers only the chapters since the previous exam. There's one final piece of the project due on that day, and then final grades are due on the 16th. So by the end of the day on the 16th, you will be able to see all of your final grades in Banner. All right. Any questions on any of that procedural stuff? What's coming up? Or any questions from chapter 10 that we finished on Monday on current liabilities, installment notes, anything else? All right. I will assume we are good and we will move right ahead with our new chapter. So I already gave you a little bit of a preview about Chapter 11, dealing with the most common type of long-term liability, and that is corporate bonds. You can see we have on this slide 4 learning objectives. These are the 4 that we are going to be covering in this class, and then on the 18th when we come back. So the entire chapter is about bonds and how do we record them, how do we calculate interest. And so we're really going to, like similar to what we did in Chapter 9 when we went through the life cycle of the long-term assets, property, plant, and equipment, we're really going to do the same thing here for bonds. We're going to start with, why does a company issue bonds in the first place? How do you know how much those bonds are worth? How do we record it when we sell the bonds? How do we record interest as each interest payment comes due? And then what happens at the end of the life of the bonds? So there's a lot going on in this chapter. We have enough to do without doing this. So what you see on this slide, these are the learning objectives that go with the appendices to the chapter, but we are not covering these. So I only leave the slide in here so that I remember to tell you we're not covering these. So you are not responsible. We're not required to be able to find the selling price of a bond. I will talk about that because I think it's interesting, but it's not something you will need to replicate. And we are also not covering the effective interest rate method, and you don't even need to know right now what any of that means. But I will talk about it, I will explain the difference, but we will not be using that technique in this class. We have enough to do with what's in the regular chapter without covering the stuff that's in the appendices. Oh, before we get too far into that, let me show you one other thing. In Blackboard, if you were to go to the reference materials folder for this chapter, you will notice that there are 3 different pages of information here. And so lots of information. We will be referring to this page in particular, formulas for amortizing bond discounts and premiums using the straight line method. The 3rd page is using the effective interest method, and if you were paying attention, you will have noticed that that was one of the learning objectives from the appendices that I told you we're not doing. And so this 3rd page is really here just for information purposes, but you will not need the formulas that are here because you're not responsible for doing that. Again, I will talk about the difference between these 2 methods, but lucky for you, we're doing the easier one, the one that takes less time and energy to calculate. So that's a good thing for you, but we'll talk about the difference between the 2. So those 3 pages are in here. I will refer to them. I will likely pull them up as we're working through some of the problems to get the formulas and remind you of where those formulas can be found, and maybe pull some of those formulas over to our exercises when we need them. My approach with those formulas might be a little bit different than the way the book approaches it. The end result is the same, but the way I write the formulas might look a little bit different. And I write them the way I do because I think it makes more sense that way. So I am never a fan of just giving you a formula and having you plug in numbers and not have any idea what it means or what to do with that. So we'll talk about, again, why those formulas look the way they do and what we're actually calculating and how to use that as we work through the chapter. Any questions before we really get started here? Okay. So what are bonds payable? What is a bond? A bond is really a way of borrowing money, but from the public rather than from a bank, from a lending institution like the bank or the credit union. It's one of the advantages of the corporate form of organization. And I'm going to put this on the screen because I think this is an important concept. One of the advantages of being a corporation, being a publicly traded corporation specifically, is, and this is, I'll write the phrase on the screen, and I'll talk about what it means. One of the advantages is the ease of capital generation. What does that mean? When we talk about capital generation in this context, we're talking about financial capital. We're talking about cash. So one of the advantages of being publicly traded is you can go right to the public to raise cash, to get more money, financial assets to run your business, to expand, to grow, to do whatever you need to do to be more effective with your business. And there are really two different ways that companies can, publicly traded companies, can go to the public to get cash. The first one is our focus for this chapter, which is bonds. And the second one is our focus for the next chapter, the chapter that we cover right after the break, which is stock. So by saying that a company is publicly traded, we are saying they have stock that's sold to the public. But that's not the only way that they get an infusion of cash from the public. The other way is by selling bonds. So what's the difference? Well, when we think about the fundamental accounting equation that I apparently can't spell today. So here's our fundamental accounting equation. We learned this in chapter 1. And so bonds are part of the liabilities piece, and equity, or stock, is part of the equity piece. They are different in that a bond represents a borrowing. You have a legal claim against the assets of that company, and bonds are actually above stock in terms of the order that you would get repaid. So if the company were in financial difficulty, if it were shutting down and dissolving, or if it was maybe going through bankruptcy, the bondholders should be paid first. And then the stockholders get whatever's left. So we'll focus on that, the stockholder piece again in chapter 12. Our topic for this chapter is just the borrowing part, the bond part. So a bond pays interest. That's why investors are willing to buy them, because they get a return on the investment. And the return is at a set rate, a predetermined rate. Here's the interest rate you're going to pay. So you would invest in the company, you would buy their bonds, the same reason you might buy a government bond. So government bonds are also part of this conversation, although government bonds are a little bit different in that they are, at least the U.S. government bonds are considered relatively risk-free. So we talked about that back in the chapter about cash and internal controls. We talked about cash equivalents. And we said relatively risk-free, such as government savings bonds. But it's really the same concept, that you buy the bond up front and then you collect interest or earn interest during the life of the bond. One of the differences for a corporate bond, the interest payment is made generally, and for our purposes, corporate bonds pay interest every 6 months. Unlike a government bond that matures and then you collect all of the interest. So you're earning interest and the bond price goes up over time, the value of the bond goes up over time, but you don't get that periodic interest payment like you do with a corporate bond, typically with a corporate bond. So we have to go through some terminology here. as I said, we're going to start with the life cycle of the bond. So in chapter 9, which was the long-term assets chapter, I said one of the things I wish was done in a different order in this textbook. And in a textbook I used to use, it was in the order I'm about to describe. We talked about, it would be nice to talk about why does a company or how does a company make a decision that they're going to buy some long-term asset? And that decision is always going to be based on, or should always be based on, it's what's in the best interest of the business. It's what will help us be more profitable, more efficient. It will save us money in the long run if we buy this new asset. Part of that discussion, part of that decision is, well, where are we going to get the money to buy it? And there are really three different places, three different sources for the money if we're looking at some long-term capital kind of project. I've already mentioned two of them today. We can borrow the money, and the most common way of corporations borrowing money is through issuing bonds. Or we could sell stock, and we could bring in new owners, new investors in the company. The third way is in what I call internally generated capital. So the company has been making money and has saved up money, just like you or I, if you want to buy a new car, you want to buy a house, maybe you save up some money to buy that or to make a down payment on that. A company can do that same thing as well. So we're borrowing money through the issuance of bonds because we have some project that some capital investment that we want to do, we need to make for the well-being of our company, and we have decided that the best way to do that is by borrowing the money. And so what's the next step? Well, we're a publicly traded company. So remember back in chapter 1, we talked about the SEC, Securities and Exchange Commission. It's a governmental agency whose responsibility is for oversight of publicly traded companies to protect the public. And so if we want to issue bonds, the SEC has an interest in that. They want to know, are we telling the public everything they need to know? Is this a risky investment? Are we doing what we should do, due diligence? Are we doing what we should do to protect the public? And so we need to get permission is what it really comes down to. We need to get permission in order to sell these bonds, to do the bond issue. And part of that permission is we then need to tell the SEC, here's what we plan to do. We want to borrow this dollar amount. And you can see on the screen right now, the dollar amount we plan to borrow is the principal. We've seen that term before in the simple interest calculation. The principal was the face value, or the dollar amount that we are, of the note, is the way we've talked about it in earlier chapters. So the principal is the amount we're going to borrow. We have to say, here's how much we want to borrow. And maybe it's, I'm just going to throw numbers out there, maybe it's $100,000. Well, most bonds are issued in denominations of $1,000 or multiples. So you might have a $5,000 or a $10,000 bond. Mostly what we will talk about is the $1,000 bonds, just because it makes our math nice and simple. So if we wanted to borrow $100,000, we might tell the SEC that we want to sell 100 $1,000 bonds. Okay, so that's the first step. How much are we planning to borrow? The face value or the principal that we plan to borrow. We also have to tell the SEC, and here's how much interest we're going to pay. So we have a stated interest rate. Again, I'm just throwing numbers out there. Let's say we're going to pay 5% interest. Well, how do we know what interest rate is appropriate to say we're going to spend or we're going to pay? Well, we look at what other bonds are paying right now. What are interest rates in the market? So we do a kind of an environmental scan and we say, bonds of other companies that are of similar risk that look like us are paying 5%. Investors are demanding 5%. And so we tell the SEC, we're going to borrow $100,000 and we're going to pay 5% interest on an annual basis, but we're going to make an interest payment every 6 months. We're going to make half of that interest payment every 6 months. And here are the dates. Maybe it's, I don't know, February 1st and August 1st, whatever. We pick 2 dates that are 6 months apart. We say those are the dates we're going to pay interest. So we've given all of this information to the SEC, how much we're going to borrow, what interest rate, when we're going to pay, also how long, what's the maturity length or the duration of those bonds. So the bonds could be 5 years, 10 years, 20, 30, 50. There are 100-year bonds out there, believe it or not. Not very many of them, but they're out there. And so we say, we give all this information up front. Here's what we want to do. And the SEC comes back and says, okay, go ahead. You can sell those bonds. You have our permission. You know, we're protecting the public here and you're doing the right thing. So go ahead and sell your bonds. So, you know, we're in business to make widgets. We're not in the bond selling business. So we're probably contracting with some kind of an investment firm to actually handle that sale, the promotion and the sale for us. There are, in order to promote that, and I didn't pull one of these up, but I should have. Let me see if I can find one quickly here without wasting too much of our time. I'm going to show you what these look like. Yeah, no, I didn't want James Bond's tombstone. Let's see. So here we go. No, why is it not showing me what I want to see? Example. Okay, there's what I was looking for. So it sounds bizarre, but they refer to them as tombstones because they look like the inscription on a cemetery marker. So here are finally some examples of what a bond tombstone looks like. And as I said, it really is, and that's for stock, so that's not what I really want. It really is a summary of the information that I just described. And unfortunately, because I put in tombstone announcement, the ones I'm seeing here are all for stock, but you get the idea without wasting any more of our time. It's an advertisement that summarizes all of this information. XYZ company is raising money. Here's the dollar amount we're looking for. Here's how many bonds it is. Here's the interest rate we're paying, the dates of the, the duration, how many years long is this bond? How long is it going to be until you get your money back? And so the company puts together, or the investment firm that they use, puts together the tombstone and advertises, hey, we're going to be selling these bonds. And then the date comes and the bond issue is opened up or put up for sale and people can start buying it. So we're still at the very beginning though here. We're planning on issuing the stock, or issuing those bonds. As I said, we need to get through a little bit of the terminology related to this. There's a couple more terms on this slide: term bonds and serial bonds. When you, the company, you plan to issue these bonds, you make a decision. Do we want to pay all of this back at one time? Or do we want to pay it back over a period of years? If we plan to pay it all back at one time, 5, 10, 30, whatever years down the road, those are called term bonds. And all of the bonds in the series mature or get paid back at the same time. But we might decide, you know what? I said we were going to borrow $100,000. I don't really want to have to pay back $100,000, let's say 10 years from now. So rather than paying all of it back at once, let's pay back $10,000 a year for the next 10 years. That would be called a serial bond. And so if you're going to buy one of those bonds, you might buy one that's due in 1 year, you might buy one that's due in 5 years, or one that's due in 10 years, or anywhere in between. A serial bond issue is helpful for a company that wants to be able to phase in that payment. And so they save money in interest because the bonds that mature in 1 year only get 1 year of interest. And they also phase in those payments. So they aren't facing that big, balloon payment of $100,000 at the end of the 10 years. Again, it's up to the company which one of those that they choose to issue. Bonds also can be convertible. So I'm going to talk about the 2 bullet points on this slide separately because they're totally different issues. Unlike the last slide where we had it's either a term bond or it's a serial bond issue, these are totally different topics. It's not convertible or callable. Your bond may be neither. It could actually be both convertible and callable. So let's talk about each one separately. A convertible bond. Well, what does convertible mean? It means it can be changed into something else, right? So if you have a car that's a convertible, you can put the top down, change it into a different looking car. Bonds can be convertible. Now, not all bonds are convertible. In fact, most bonds are not convertible. If you are buying a bond, you would know when you buy it if it's convertible or not. I didn't point out the term on the previous slide, but if you read even the things that I did not say, there is a bond indenture, which is really the contract between the bond seller and the bond purchaser. And it includes all that same information that I've already described, the total bond issue, what's the interest rate, the payment dates, the maturity dates. In that bond indenture or the contract, it would say whether it's convertible, whether it's callable. A convertible bond can be converted or changed into common stock at a preset rate, at a preset conversion factor. So it might be something like this. The bond is convertible at a rate of 1 bond equals 5 common stock shares, or 10, or 2, or 7, or whatever number the company decides. Who gets to decide that? Well, the entity that buys the bond, that owns the bond, gets to decide whether or not to convert it. They may never convert it. They may keep it as a bond until it matures. At any given time, they can decide to convert to common stock if the bond is convertible. Now, once they convert, they can't change back. They would have to sell the stock and take the proceeds from the stock and buy another bond. But at any given time while they hold that convertible bond, they could decide, you know what, I'm going to change into stock. So why would they do that? What's the advantage? I already described that bonds are a debt and stock is equity. Stock is ownership in the company. Stock is riskier for one reason we already said, because if the company is going to close or go bankrupt, the bondholders get paid first. They supersede the stockholders. Okay, the stock is subordinate to the bonds. So bonds get paid off, then if there's anything left, the stockholders get what's left. So bonds are less risky. Someone who's risk averse, an investor who really wants stability and not risk, would prefer to have a bond rather than stock. That being said, the bond has a stated interest rate. In my example, I said, maybe we're paying 5% interest. Well, that means your return on that investment is going to be 5%. As long as the company pays their interest, you're getting 5% a year, every year for the life of the bond. And then you look over at the stockholders and you see the company's doing super well, and typical long-term returns on stock range in the 6 to 7% range over decades. And so if your interest rate is 5%, and you see the company doing really well, and maybe the stock is returning 10%, you're like, wait a minute, why do I have these bonds? Why am I accepting 5% when I could change into stock and get a better return on that investment? And so you may at some point as the investor decide, you know what, the extra risk is worth it because the stock is doing a lot better than the bonds. And I feel comfortable now, the company's doing well, I'm going to go with the stock. So that's one explanation for why an investor might choose to have a convertible bond, because it allows them to change into common stock at a predetermined rate, 5-to-1, 2-to-1, whatever it is, when the investor decides the risk is worth it. And maybe they never decide that and they just hold on to their convertible bond and let it mature and go about their business. If the bond is convertible, I already said it's up to the investor to decide when to convert. And we look at the other term on the slide, which is bonds can be callable. What does that mean? If a bond is callable, it means at any given time, the company that issued the bond can say, we want our bond back. We're going to buy it back from you at this preset price. And the preset price is going to be generally something higher than the face value of the bond. So if it's a $1,000 bond, it might be that the call price is, say, $1,050. Again, if you buy a callable bond, you know it's a callable bond. It's included in that bond indenture. It tells you that it's callable, and here's the price. We're going to talk about bond prices in just a moment. So who gets to decide whether a bond is called? The company. So if you buy a bond that's callable, you have no control. If the company says, we want our bond back, here's your $1,050, you have to return, you have to sell it to them at that price. And so that price really acts as a cap on the upside of the bond price. If the bond is callable at $1,050, you're never going to pay $1,100 for it, because the company can turn around tomorrow and say, here's your $1,050, I'm calling that bond. Like, but wait a minute, I just paid $1,100 for it yesterday. Their reaction is going to be, well, that was a bad decision on your part, because it's callable at $1,050. You have to sell it to us for that price. If a bond is not callable, then a company wants to get it back, wants to bring it back in, retire it so that they can stop paying the interest on it. And we'll talk about that in one of our exercises. If that happens, the company wants to get their bonds back, they can always buy them at whatever the prevailing market rate is. So if that bond price was $1,100, the company can say, okay, here's your $1,100 and buy it on the open market, just like any other commodity. If I wanted to buy a bond, I can go buy it for whatever the market price is. The company can also buy their own bonds. In Chapter 12, we will talk about the company can also buy back its own stock in that same way by paying whatever the prevailing market rate is. Lots of talk here. Any questions about what we've talked about so far? Any of the terminology, anything so far? Okay. So our next topic is going to be, well, how do we determine the price of a bond, or how are bond prices stated? I've already talked about that. So remember I said a couple minutes ago, when the company decides they want to issue a bond, series of bonds, they have to put together this prospectus that goes to the SEC that includes all of that information we talked about. The total amount we're borrowing, the interest rate, the interest payment dates, the maturity length, and they send that all to the SEC. And then there's, of course, going to be a time lag between the time they're putting that information together, including the interest rate. They send it off to the SEC. The SEC gets back to them and says, okay, go ahead and sell it. Now they advertise it and they start selling the bonds. Well, if you know anything about interest rates, if you've ever tried to borrow money, say to buy a house, buy a car, you know that interest rates change over time. And that happens in the bond market as well. Interest rates on the open market also change. Really, you know, they can change on a daily basis, or throughout the trading day, the interest rates can fluctuate. And so we agreed in my example, we said we would pay 5% interest. But between the time we say we're going to pay 5% and we actually sell the bonds, interest rates in the market may no longer be 5%. Interest rates could go up, interest rates could go down. It is a well-established fact that there is an inverse relationship. I'm putting this on the screen. There's an inverse relationship between bond interest rates, I should just say bond prices and interest rates. There's an inverse relationship between bond prices and interest rates. If interest rates go up, bond prices go down. If interest rates go down, bond prices go up. And we'll see why that is later in the chapter. But what does this mean? So in my example, I said we would pay 5% interest. So that is our stated interest rate. If you were reading the parts of the last slide I did not read out loud to you, if you were reading the slide, you would have noticed the term coupon rate. And the term coupon rate is really an anachronism now. It's something that's out of place, out of time in today's world, because most bonds no longer have coupons. A coupon bond, and I should put these terms on the okay, so another set of terminology that relates to bonds. Bonds can either be registered, which means the company knows who owns it, and they automatically, you know, they know who gets the interest payment every 6 months, or they can be coupon bonds. If you've ever seen the first Beverly Hills Cop movie with Eddie Murphy, and my husband was flipping channels this weekend and he happened to cry. I'm like, oh, wait, I should watch that because I talk about this in class and I knew it was coming up this week. Has anyone ever seen that movie? You familiar with the movie? Pretty familiar? No? The first Beverly Hills Cop.
I don't think I've seen it.
It's a really good movie. I recommend it. It's funny. But in that movie, and this won't ruin the movie for you if you're going to go out and watch it, but in the movie, the reason that, so Eddie Murphy's a New York City cop, and in the movie, he decides to go to Beverly Hills to investigate this crime because he has a buddy, Mikey, and Mikey has been in Beverly Hills working, and he's been doing something he probably shouldn't have been doing, apparently. And he shows up at Eddie Murphy's apartment building, and he gets executed like gangland style execution in the hallway of Eddie Murphy's apartment building. And that, you know, makes Eddie mad because this is his like childhood friend or whatever. And so he goes out to Beverly Hills, and that's the very beginning of the movie, why he ends up going out there. So the reason he gets killed, the reason Mikey gets killed is because he has stolen something from his employer. And what he had stolen, you are told in the movie, were German bearer bonds. A bearer bond is the same concept as a coupon bond. A coupon bond means they're literally, you have a piece of paper or a book of coupons that you tear one out and you take it to redeem your interest. So whoever has the coupon book can claim the interest, can get paid that interest. Contrast that with a registered bond where the company knows who owns the bond and they just mail you the check or whatever for your interest. A coupon bond is stealable because if you have the coupon book, you can collect the interest on it. It's a really good movie. You should watch it. But the older I get, the more likely it is that people in class don't know what I'm talking about with that movie. So a coupon bond has coupons that you redeem for the interest. When we call the stated interest rate a coupon rate, that really is something that no longer is really applicable because very few bonds are coupon bonds anymore. But we still use that term coupon rate, even though it still doesn't apply to an actual coupon that you tear out and redeem. Okay, so back to my example, I said I was going to pay 5% interest. And the reason I told the SEC I was going to pay 5% interest is because that's what the market rate was when I was putting together the prospectus for these bonds. But in the meantime, from the time I said, yeah, 5%, till the time we actually sell the bonds, interest rates have been changing. And they could go up or they could go down, right? So let's think about this. If my bond is paying interest of 5%, let's just say that the market interest rate was 5% when I said I was going to pay 5%, but let's just say it's now 6%. If I'm paying 5% and you're paying 6%, some other bond is paying 6%, and you are an investor, which one do you want to buy? All else equal, which one do you want to buy? The one that pays 5% or the one that pays 6%? You'd rather have the 6% one, right? Because it's paying more interest. So all else equal risk and so on, you're going to look at my 5% bond and say, I don't think so. I'm going to take the 6% bond because I get more money that way. I get more of a return. But I still want to sell my 5% bond. So without thinking about bonds, if you have something and you want to sell it and nobody wants to buy it, what do you have to do to get people to buy it from you? What do you do?
Lower the price.
Thank you. You lower the price. You put it on sale, right? So if our stated interest rate, 5%, is less than the market rate of interest, we would say that those bonds are selling at a discount. We have to lower the price. So remember, I said the inverse relationship between bond prices and interest rates. What happened? The interest rate went up from 5 to 6%, and we had to lower our price to get people to buy it because now our interest rate doesn't look so very good. We still have to pay the 5% because remember, that's what we told the SEC we were going to pay. So we don't have any choice. We're going to sell these bonds, we have to pay the 5% interest. But to get people to buy them, we'll have to lower the price and they sell at a discount that way. Well, what if the other happens? We said we'd pay 5%. Market rates have fallen. The market rate is now 4%. Do people want our bonds now? Do our bonds look pretty good now because we're paying more than the market rate of interest? People are going to want our bonds, right? And so competition for our bonds is going to actually make the price go up. Again, that inverse relationship. Interest rates fall, bond prices go up. Our bonds look more attractive. We can get more money for them. If we are paying a higher rate of interest than the market rate of interest, we say those bonds are selling at a premium. We're going to get more than the face value. And of course, the other possibility, although much less likely, is that bond interest rates stay exactly the same. We said we'd pay 5%, the market rate is 5%. And those we would say are selling at par, just like in golf. They're selling at par or at face value. And so those relationships, I can get out of here. Those relationships are described in Blackboard on the page that says valuing bonds and finding bond prices. I described right here what that means. The three terms, premium, discount, and at par. What does that mean? What's the relationship between the interest we are paying, the stated interest rate, and the market rate of interest? And the last thing I need to say before we go to our first exercise is when we talk about prices for bonds, we don't give the price in dollars. Instead, we state the price as what's called an index. And I have that right here. We state the price as an index. Make that a little bigger so people can see it, which is really a percent without the percent sign. So those three scenarios I talked about, bonds selling at a premium, at a discount, or at par. Selling at par means they're selling at exactly their face value. They're selling at 100% of the face value. And so we would say the price of those bonds is 100, meaning 100% of the face value. If the bond interest rate we are paying is higher than the market rate of interest, the bonds are selling at a premium, the price would be greater than 100. So 105, 107, 106.3 or whatever. Those are premium prices. The price is higher than the face value, greater than 100. And the other side of the coin, if our interest rate is not attractive, we have to discount our bonds and the price would be less than 100. Not negative, but less than 100, 99, 92, 97.4, or whatever. So they're stated really as a percent without the percent sign. And we're going to go to our first exercise now that we have all of that behind us. We've heard really almost all of the terminology that we need for this chapter. We know about bond pricing. We know what the price means. And so we can do our very first exercise, which you can see is super, super quick. Before we look at this though, any questions about what we've talked about so far? Okay. So U.S. Steel Corporation's bonds were due in 2022, 7.5%. That's the interest rate. That's the stated interest rate. These bonds are paying 7.5%. And they were reported as selling for 103.2. That's the price of the bond. Again, it's really a percent without the percent sign. We call it an index. Were the bonds selling at a premium or at a discount? So the price is greater than 100. That means they're selling at a premium. Why are they selling at a premium? Well, because U.S. Steel said they would pay 7.5% interest, and other bonds of similar risk are paying less than that. And so our bonds become relatively more attractive because we're paying a higher rate of interest. And so what that tells us is that the market rate of interest for similar quality bonds, by quality we're really referring to risk. So there are companies out there, Moody's and Standard & Poor's come, or S&P, Standard & Poor's come to mind. They are services that grade bonds, that rate bonds for their risk. And they're given like a letter, you know, an A bond is less risky than a B bond, that kind of thing. So our bonds, U.S. Steel's bonds are selling at a premium greater than 100 because the market rate of interest for similar quality bonds, bonds of similar risk, have a similar grade, the market rate of interest was lower than 7.5%. So our bonds look more attractive. Okay. Told you that was a really quick and simple exercise. Does that make sense though? And I showed you in Blackboard where you can go to look. I've already put it into note form for you. And you can always refer back to the information that's here in Blackboard to help with those questions. Okay. So we've spent the last close to an hour talking about the first part of bonds, why we sell bonds, because we need to generate some capital. We go to the public, you know, getting 10, in my example, I'm going to stick with those same numbers. I said I wanted to raise $100,000, so I'm going to sell 100 $1,000 bonds. That's less risky. You know, each individual could just buy one $1,000 bond. That individual is risking the $1,000 investment, but that's less risky for that one investor than going to one bank or one entity and borrowing the whole 100,000. So it kind of spreads out the risk among different investors. So we've talked about why a company would want to issue bonds, how they go about getting permission, all the things they have to decide, and then they've got permission and they're ready to go ahead with the bond issue. Now, one thing you will notice, as has been the case in other situations in class, because we're looking at a classroom exercise, they frequently simplify for us and make it a little easier for us to do the accounting. And one thing that will almost always happen, we have one exercise where we say, okay, let's pretend that's not true. But for almost all of our exercises, the same thing is going to happen. That we issue the entire bond issue on a date that corresponds with one of the interest dates. And that's extremely uncommon. So we, as I said, we will look at one exercise where we see, well, what happens when that doesn't, you know, how do we do it? How do we handle it when we don't sell the entire bond issue on the same day, which happens to be the first day of the new interest period? It just makes things easier for us because we don't have to accrue any interest in that case for the time lapse between the interest payment date and the day we sell the bonds. So it just makes it easy for us. In this next exercise, you'll notice it says that we sell these bonds at face value. And so just for this exercise, we've got a little bit of a simplification there because it would almost never happen that we sell the bonds at exactly the interest rate that we agreed to pay. It's very unusual that the market rate of interest is exactly the rate of interest that we said we would pay. Very unusual for bonds to sell at face value or at par. So let's read everything that it says here. Thomson Company produces and distributes semiconductors for use by computer manufacturers. Thomson issued $800,000 of 10-year, 6% bonds on May 1st of the current year at face value, with interest payable on May 1st and November 1st. The fiscal year of the company is the calendar year. So the first thing we're asked to record is when we issue the bonds for their face amount. In other words, for exactly $800,000. So when we issue the bonds, we're borrowing the money. And so what do we have that we didn't have before? Well, we have money, right? Cash. Our cash is going to go up by the amount that we sold them for. In this case, we're told the very unlikely scenario that we sold them for exactly their face value or at par at 100% at a price of 100. But what else do we have? Well, unfortunately, we now have a liability to repay $800,000. The bonds payable account is always going to carry the face value of those bonds, even in the much more likely scenario that we sell them at a premium or at a discount, and we'll see that in upcoming exercises. How do we do that? But the bonds payable account, the long-term liability, and I say long-term because these are 10-year bonds. So we're not going to pay back the face value for 10 years. Every 6 months, we're going to make an interest payment. But we don't have to pay back the $800,000 for 10 years. Any questions about that first entry? Okay. So now we move ahead. We issued the bonds on May 1st. We now have the $800,000 and we're doing whatever we wanted to do with it. Maybe we're expanding our manufacturing base or buying some new equipment, I don't know. But whatever we said we were going to do with it, we go ahead and use the money. Now we get to November 1st and it's time to pay the interest on the bonds. The interest that we pay, and I've got these formulas. I want to use the ones that are straight line method. So the formulas that you need for this are right here on this page. Again, make sure you're using the straight line method. That's what we are doing in this class. The other method, effective interest, I'll talk about, and it's covered in the appendix, but we're not going to be doing exercises related to that. So right here, actually, I'm gonna copy both of these. Try to copy both of these. Where am I gonna fit these in? Oh, right here. Huh. Okay, it's a little big. Let me move it. Maybe I can move it down here just for the moment. So here are the formulas for calculating the bond interest payment and the bond interest expense. They seem right now to be quite complicated formulas, but remember these bonds sold at face value, so there is no premium, there is no discount. So what that tells us is the bond interest payment is going to be exactly the same as the bond interest expense because they were sold at par. So for this exercise, our calculations are really just a simple interest calculation. Face value, that's the principal, times the face interest rate, that's the interest rate, the I part of the, the R part of the I equals PRT formula. And then the time period, it's a half year. So this formula to calculate the bond interest payment really is the same as the I equals PRT that we learned back in the receivables chapter. So for this bond issue, let's calculate the interest payment. The interest is the face value, the principal amount that we borrowed, $800,000, times the stated or face interest rate. We said we would pay 6% interest. And we're going to multiply by 1/2 because that's the time period. So there's our interest that we have to pay. So what do we get? Anyone have a number for that?
24,000.
Thank you. 24,000. So the interest on this bond issue is $24,000 every 6 months for the life of the bond. The bond is a 10-year bond. So if we pay interest every 6 months, we're going to make 20 total interest payments of $24,000. 20 total interest payments of $24,000. And here we are on November 1st, and we're going to make that first interest payment. So what do we use to make the payment? Cash. And we report the interest expense. The interest expense is going to show up on our balance sheet. You'll notice that issuing the bonds here on May 1st, there was no income statement impact there. Cash is an asset, our asset went up. Bonds payable, liability, our liability went up. Totally balance sheet. But now when we pay the interest, the interest expense is going to show up on our income statement. Everybody okay with that? Okay. So we paid that interest on November 1st, and at the end of December, our fiscal year ends. And so we've talked many times about the matching principle. We now owe 2 months worth of interest. We owe the interest for November and for December for this bond. We're not going to pay the interest until May 1st. But the matching principle says you owe it, you need to record it. You need to show the expense on your income statement, and you need to show the payable, the liability to pay those 2 months worth of interest on your balance sheet. So let's do one more interest calculation here. Same formula, basically I equals PRT, same interest rate, but now it's just 2 months rather than half a year. It's only 2 months worth of interest. And so at the end of December, again, we're not going to pay the interest early, but we do have an obligation to show the interest cost on our income statement and the liability to pay for it on our balance sheet. So we're going to show the interest expense, 2 months worth or $8,000 worth. And then on the balance sheet, we're going to show the interest payable. We do not just put it into the bonds payable because that's reserved for just the face value or the principal. The interest payable would be a current liability because we have to pay for it in 4 months when we make the next interest payment. The bonds payable, as I already pointed out, for the first 9 years, the bonds payable is a long-term liability. Okay, so this is how we record when the bonds are sold at face value. This is how we record the issuance of the bond, the interest payments, and then at the end of the year when we had to accrue the interest. Any questions about that? Green check marks in there. Okay. As I said, the situation we're looking at in this exercise is unique and not very common that we would sell those bonds at face value. And so let's move ahead to our next exercise. And we can see already from the title of the exercise that these bonds are going to be issued at a discount. But as we read the given information, we would have known that even if they didn't tell us in the title of the exercise. So this is a much more realistic scenario, but it's also a little bit more complicated. On the first day of its fiscal year, Chin Company issued $10 million. That's the face value, the principal that we're borrowing, of 5 years. So that's the duration or the maturity length of these bonds, 5 years. 7% is our stated interest rate. They issued these bonds to finance its operation of producing and selling home improvement products. Interest is payable semi-annually, so we'll be paying it twice a year. The bonds were issued at a market or effective interest rate of 8%. So we had agreed to pay 7%, and that's what we told the SEC we were going to do. But in the meantime, the market rate went up 8%. What does that tell us? Our bonds are going to be sold at a discount because our interest rate is lower than the market interest rate. In order to get people to buy our bonds, we're going to have to lower the price, right? Okay, selling them at a discount. So even though they're $10 million face value, we sold them for only about $9.5 million. And the difference between those two numbers, the face value and the cash, we actually realized that difference is the discount. And the reason for the discount is because our interest rate just isn't up to the market rate of interest now. So let's think about how we report this or how we record this entry when we issue the bonds. Well, we still got some cash. That was the whole reason that we sold these bonds in the first place, was we needed some cash to finance our operations. So we still got some cash, just not quite as much as we would have hoped. Now, unfortunately, remember I went through that whole scenario of we have to tell the SEC what we're going to do, and we have to tell them, you know, the face value of the bonds and the interest rate and when we're going to pay the interest and so on. So we told the SEC we were going to issue $10 million worth of bonds. And so when the bonds mature 5 years from now, we still have to repay the $10 million in bonds. Whoops, got an extra zero in there. Unfortunately, we still have to pay back the full face value of the bonds because that's what we told the SEC we were going to do. Now we can tell that we're not done because there's an extra line in here, but at this point in chapter 11, you also should recognize we can't be done because the debits and credits aren't the same. We need another debit to make this thing be equal. And so how far apart are those two numbers? $10 million minus the cash we received. How much was the discount? $405,585. That is the dollar amount of the discount. That's how much, basically, that's how much we had to lower the price to get people to buy them. And I'm going to call that the discount on bonds payable. It's how much we had to lower the price to get people to buy them because our interest rate just wasn't matching the market rate of interest. Does that make sense? Okay. In our next exercise, we're going to be looking at a similar situation, but we're going to issue at a premium. So we'll see what that looks like in the next exercise in case you're wondering. Okay, now let me bring in these formulas again. And I'm going to collapse this navigation thing on the left so that I can have room to put these formulas. And still have room to do the math part. So these formulas are the formulas from Blackboard. I just copied them from Blackboard, and now we'll see how to use them. Okay. The next journal entry is to record the first semi-annual interest payment. And again, as I said in the last exercise, even though they don't explicitly state it, the assumption is we sold all of those bonds on the first day of the interest payment, and now it's 6 months later, and we're going to make the interest period, excuse me. And 6 months later, we're going to make the first interest payment. And I'm going to be using these formulas to do that calculation. Just want to leave that alone. So we'll start with the bond interest payment. So the payment is how much we're going to send in cash or checks, of course, to our bondholders. So the payment, using that same formula that I just copied out of Blackboard, the payment is based on the face value of the bonds, $10 million. Times the face interest rate. That's the interest rate we said we would pay, and that's the 7%. And then it's a half-year payment, so we're just going to multiply by 1/2. So we are going to be paying a total of $350,000 every 6 months for 5 years, a total of 10 payments of $350,000. It does not matter that these bonds were sold at a discount. We still have to pay the full $350,000 because that's what we told the SEC we would do. And that's what we told the bondholders we would do. We will pay you 7% of the face value of the bonds every year for the life of the bonds. And so when we pay these bonds, the payment, the credit to cash, is $350,000. But we also need to record the expense, and we have a separate calculation here for the expense. Remember, I said in the last exercise, because there was no premium or discount, we could disregard this part of the equation, and the bond interest expense is equal to the bond interest payment when they're sold at par. But that's very unusual. So let's use the next formula. The bond interest expense is, oh shoot, sorry, I need to get, my bad. I need to get, let me get rid of that. And I need to pick up one more formula. I just did, there we go. Let me pull in. Yeah, I need actually 2 more. Pull in this. Okay, let me pull this in. I forgot I was going to need this formula, which we did not need when they were sold at par. I can kind of sneak that in up there. Okay. So the other formula that we needed in this exercise, we did not need in the last one, is how do we amortize that bond premium or discount? We already know what the discount is. We calculated it in the first entry, $405,585. So the amortization, and if you remember, we saw that term, that word amortization in chapter 9 when we talked about intangible assets, and I told you it would come up again in this chapter. The root of that word is mort, which means death. And so amortization means we are gradually killing off the premium or discount. We're gradually reducing it down to 0. We are using the straight line method for calculating, for amortizing bond premiums or discounts, which makes this simpler for us. To find the amortization, if we look at that formula that I've given you, we take the original discount, which we calculated was $405,585, and we divide by the number of interest payments. So we're paying interest twice a year for 5 years. That's a total of 10 interest payments. So 405,585 divided by 10, and it does tell us to round to the nearest dollar. Oops, got me in the wrong spot. Sorry, 405,559. So it's 558.5, and we're going to round up that 0.5. So the rounded to the nearest dollar amortization is $40,559. Again, I just used the formula that's in Blackboard and plugged in what we know. Okay, everybody okay with this? Okay. The discount has a debit balance. So to get rid of that, we need to credit that account. We need to credit the discount to make that number get smaller, right? It has a debit balance of $406,000. If we credit that account, it was going to bring that balance down to about $365,000. Everybody okay with that so far? Makes sense so far? Now we can calculate the interest expense. And the interest expense, whoops, let me get my tool back up here. The interest expense is the bond interest payment, which was $350,000. That's the first thing we calculated. If it's a premium, we would subtract the amortization, or if it's a discount, we add the amortization. And that makes sense when we look at it, because that's the dollar amount that's going to make that entry balance, equal dollars debited and credited. Okay, so again, I'm just using the formulas that I provided to you in Blackboard, plugging in the information we know to find the interest payment, the amortization, and the expense. Anybody with questions at this point? You're going to love this. Number 3 says the second semi-annual interest payment. Well, the interest payment has to be the same every single time. Has to be the same every single time, because that's what we told the SEC we were going to do. So that's what we have to do. Remember, I told you that there are 2 different methods, and I showed you in Blackboard that there are 2 different methods, the straight line and the effective interest method. Well, the straight line method is very similar to the straight line method that we talked about in Chapter 9 for depreciation. It's the same every time. So the amortization is the same as it was with the first payment. And that means the expense is also the same. So every single time we make a payment, 10 times over 5 years, the entry looks exactly the same, unless we have to accrue interest, which we're not told to do in this exercise. The effective interest rate method, the one that you're not responsible for doing, but that I did provide you with information about how to go about it, that method, the interest expense actually changes a little bit each time. So determine the bond interest expense for the first 2 years, or sorry, for the first year, the first 2 payments. We made 2 payments in the first year, but so we recorded expense, exactly the same expense each time. Although we rounded it. So 390,559 times 2. Why was the company able to issue the bonds for only 9.6 million rather than 10 million? Because the market rate of interest is greater than the contract rate of interest. We said we'd pay 7, the market wants 8. Therefore, that should say investors, not inventors. That's a typo. Therefore, investors are not willing to pay the full face amount of the bonds. Oh, it's okay. Just startled me. I actually thought it was coming from Zoom. What is going on? That's quite right. Okay, so any questions about what we've done in this exercise so far? Okay. Let's go to our next exercise. Excuse me. And what I want to do is erase just these calculations, but leave the formulas there. They don't fit quite as well on this exercise, but I don't want to have to redo them. We can kind of read around it, maybe. See? Maybe. Smiley Corporation wholesales repair products to equipment manufacturers. On April 1st, Smiley issued $20 million of 5-year 9% bonds at a market rate of interest of 8%. Face value, principal, $20 million. We're paying 9%. The market only wants 8%. That makes our bonds relatively more attractive. They sell at a premium. And so the cash we received was more than the face value. They sold at a premium. So to record the issuance of these bonds, just like with the previous exercise, we received $20,811,010 in cash. That's how much we have to record as debited to cash. And the bonds payable is always going to be, one extra zero again. The bonds payable is always going to be the face value. That's what we have to repay. Whether we sell them at a premium, at a discount, or at par, when the bonds mature, we have to pay the face value, regardless of how much we received up front. And then the premium is going to be, how much do we need to make this entry balance? How much extra cash did we receive over and above the face value? The difference between the face value and the cash was $811,010, and that is the premium. And so what you'll notice is that the premium has a credit balance where the discount in the previous exercise had a debit balance. Make sense so far? Anybody with questions? Okay. So let's go on to entry B. Journalize the entry to record the first interest payment. We already know that when we use the straight line method, the first interest payment looks exactly the same as the second, the third, the fifth, and the 10th, and then however many there are. That's what straight line means. It looks the same every time. So let's calculate our interest payment using the formula we have right here for the interest payment. Payment will be what we told the SEC we would do. Face value times the stated interest rate, and again, it's a it's a half-year payment. And so I found a payment of $900,000. Is that what everyone else got? Okay. Stop. So the cash we are going to send out to our bondholders, $900,000. We'll do the amortization next, and I've got the formula kind of crunched in there up at the top for the amortization. Same formula as last time. We take the original discount or premium, which was the $811,010, and we divide by the number of interest payments. So this is a 5-year bond, semi-annual payments. That's a total of 10 payments, again, just like in the previous exercise, because it happens to also be a 5-year bond. 81101, yeah. Okay, so the amortization, $81,101. We don't even have to round this time. The interest expense we record, should have put that on the screen too. Using the formula for the interest expense that I have copied over from Blackboard, is the bond interest payment, which is the 900,000 we already calculated, minus the premium or plus the discount. So last exercise, we had to add the discount. Now we're going to subtract that premium amortization. So the expense $818,899. The expense is less than the payment we have to make. And the reason, and the amortization, is how much we need to make this entry balance. And the reason the expense is less than the payment is because we said we'd pay 9%, but the market rate of interest, the effective rate of interest, is only 8%. So the interest expense we record is actually less than the cash payment that we make. And the last question, why was the company able to issue the bonds for more than the face amount? Because the market rate of interest is less than we are paying. So the price of our bonds goes up, there's a premium, and that premium, as we amortize it, actually lowers the interest expense that we report. So the interest expense we report is more like the 8% market rate of interest. And the reason I say it's more like is because we're using the straight line method here. So I'm not going to go into the whole math of it. If we were using the effective rate of interest, the effective interest rate method, I would, you would see that the interest expense actually changes each time, so that the interest expense is exactly the market rate of interest. But when we use the straight line method, the interest expense stays constant. And so the percentage actually changes a little bit over time. I don't want you to get too caught up in that. You don't need to be able to articulate that. We're not using the effective rate of interest. But I said I would explain the difference between the two, and I have just a couple minutes here, so I will do that. Let me put my green check marks in here. Is there anyone who has questions about what we have done so far in class? We've done the first 4 exercises, and we've done a lot of background discussion about bonds. Is there anyone who has a question at this point? Okay, so what we've done so far is the standard kind of entries. When we come back after the break, we will look at some unique situations like calling bonds in exercise 5 and calling bonds with a gain, and how do we report bonds on our financial statements, finding present values, and that'll be it. So before we call it a day and I let you go for your week off from accounting anyway, I just want to spend just another minute talking about, let me get those stuff off the screen, about the difference between these two methods. So the effective interest method, why do we have 2 methods in the first place? The effective interest method is a little bit different than the straight line method because it's the interest, as I already said, the interest expense we report is not the same every time. The interest we pay, the payment is the same. It has to be because that's what we told the SEC. But the interest expense actually changes a bit over time. The straight line method is easier because we do the calculation one time and we just keep using those same numbers every time. Just like straight line depreciation is the easiest of the three methods. The problem is, under GAAP, we're not always allowed to use the straight line method. We are only allowed to use the straight line method if it's not materially different than the effective interest method, because the effective interest method is actually better. As I already explained, the effective interest method gives you the same rate of interest every time. The interest expense rate percentage is the same every time, and that's not true under the straight line method. So just so you know, before I started using this book, I only did the effective interest method because it's always acceptable, but it is harder. This book presents it a little bit differently, and so I switched to straight line because that's what's in the chapter. And my policy is we don't cover what's in the appendices because we have enough to do without doing that. So my issue is the effective interest rate method is always correct. It's always better because it gives us that constant rate of interest expense. But we are allowed to use the straight line method if it's close enough, if it's not materially different. So that's my explanation for why we have both, why both exist. The effective interest rate method is better and it's preferred, but it's also more challenging to calculate. So I have the formulas in here for you, but you're not responsible for being able to implement them. But I do like to introduce that just because it is the preferred method. So we're at the end of our time together for today. If you are able to come tomorrow to the drop and review session, that's great. I hope to see you then. Otherwise, have a good break and let me know if there's anything I can do. Don't forget, registration starts for everybody the day we get back. Questions, anybody? All right. See you in a couple weeks.